Integrating non-financials to create value. Can ESG and CSR activities meet investors' expectations for financial value? The adoption of integrated reporting and sustainability metrics has generally lagged in the United States. In contrast to US companies, Japanese companies have been pioneers in adopting non-financial metrics, i.e., intangibles. In Japan, environmental, social, and governance (ESG), corporate social responsibility (CSR), and non-financial information reporting are booming now, with nearly 300 listed companies already adopting integrated reporting. Traditionally, Japanese corporate managers are inclined to tout their company's intangibles, such as human resources and social contribution, rather than financial metrics like earnings per share (EPS) and return on equity (ROE). This tendency to report intangibles could be due to the traditional Japanese value of collective capitalism, deeply rooted in an insular groupism culture and history, instead of an emphasis on individual shareholder primacy as in the US. In recent years, however, the problem at Japanese companies has been that Japan's price-book value ratio, PBR, or market capitalization to equity book value, has been stagnant and hovering around 1, i.e., without meaningful market value added MVA, which is market capitalization minus equity book value. If we assume that financial capital is related to the net asset size of the PBR equation, while non-financial capitals are connected with the market capitalization or MVA side of the PBR equation, then we would assume that Japan's emphasis on intangibles will result in greater MVA and a PBR significantly higher than 1. As you can see in Figure 1, however, if we compare the Tokyo Stock Price Index (TOPIX), which calculates the stock price index of all the Japanese companies listed on the first section of the Tokyo Stock Exchange, to the US Dow Jones and the Financial Times Stock Exchange (FTSE), MVA of the US companies is much higher. Why is there an apparent lack of value creation by Japanese companies despite their allegedly affluent intangibles? In addition to this dichotomy, there is also the issue of the investment community's continuing emphasis on pure financials. Part of this dichotomy can be explained by bank-led governance in Japan, exemplified by infamous cross-shareholdings that incur a significant corporate governance discount, with persistent effects on valuation in the past. The historical background of bank-led governance could be traced to the devastation Japan faced after World War II that resulted in no equity capital providers. The Japanese government then took the lead and offered lending via banks to revitalize the economy, which resulted in rapid economic growth. But this model was based on cross-shareholdings between banks and companies, thereby stifling the rights of genuine minority shareholders. This is one explanation for the Japanese historical tendency for corporate managers to ignore the shareholder rights and value. Lack of financial literacy explains the other part of the dichotomy. In a survey by the Japan Investment Relations Association, JIRA, IR Survey 2017, 55.9% of companies that engage in investor relations activities point out that disclosing and explaining non-financial information in connection with corporate value is a challenge. Thus, the dilemma is how to explain the enigma of why Japanese companies have PBR less than 1, while simultaneously proving to the investor community that there is value in CSR and ESG activities. Correlation between non-financials and value. In contrast to the negative MVA shown by the graph in Figure 1, numerous empirical studies back the relationship between the double IRC-defined 5 non-financial capitals and PBR by showing a statistical correlation, including the cases of Japanese companies. We argue that there does seem to be a positive correlation between intangibles and value via MVA, while keeping in mind that correlation does not always prove causality. For example, a study conducted by Cho University Graduate School of Accountancy, Are Non-Financial Capitals Connected with Corporate Value? Empirical research on Japanese healthcare sector, which analyzed Japan's healthcare sector, found a significant positive correlation between the double IRC's 5 non-financial capitals and price-book value ratio, that is, the double IRC PBR model. Healthcare companies were chosen because the proportion of companies that refer to the double IRC's framework when compiling integrating reports in that industry is high. Furthermore, other research supports the use of the double IRC PBR model by proving that the 5 non-financial capitals defined by the double IRC are related to market value added. One empirical study, Relation between Human and Intellectual Capitals and Corporate Value, PBR, sampled Japanese companies across the board and showed that the more a company's intangibles were formed from personnel, human capital, and research and development (R&D) intellectual capital expenses, the higher the company's MVA. As you can see by the square R value in Figure 3, the study found that more than 10% of MVA is explainable by R&D investment as intellectual capital, whereas another 10% or more of MVA is attributable to personal investment as human capital. This can be interpreted as significant and direct evidence supporting the double IRC PBR model, positive correlation between non-financials and PBR, synchronized non-financial capital and equity spread. Our approach is to take the best of both worlds. We should not focus only on non-financials or on financials, but management accountants should make a bridge to both sides, using what we call the ROE ESG model. As mentioned earlier, corporate value can be represented by the price-book value ratio in a way whereby accounting value, equity book value, accounts for PBR equivalent to 1, and market value added indicates PBR above 1, representing value creation over nominal book value, net assets. Then we assume that MVA is related to non-financial capital or intangibles, as evidenced by the results of the empirical research shown in Figures 2 and 3. In accordance with the residual income model RIM, MVA, or the portion that contributes to PBR equaling more than 1, is theoretically the function of future flow of ROE. Here is another way of explaining this. Non-financial capital is the added value that management should create, i.e., goodwill or the hidden value, that cannot be accounted for on a financial accounting basis, and is related to MVA. On the other hand, RIM indicates that shareholder value is the total of equity book value, BV, plus the sum of present value of future residual incomes, with its KPI as equity spread. Since equity spread is ROE minus cost of equity capital, theoretically MVA is a variable for future ROE. Therefore, ESG as non-financials or intangibles can be connected or synchronized with ROE via MVA on a long-term basis. Hence, we call it the ROE ESG model, enabling the win-win situation for both shareholders and companies, bridging sustainability issues and projects with the more traditional financial accounting and shareholding reporting worlds.